Yeah, Don. He's asking, perhaps not now, but sometime could you explain what slippage is and how it might affect our P&L? So slippage is that bid-ask spread. It is that money that you're giving up to get in and out of that trade. So on a really liquid product, let's take the most liquid thing out there, SPY. Typically, you're going to have penny-wide bid-ask spreads if you want to go trade options in SPY. Meaning, at most, you're giving up a penny to get in the trade, $1, right? Because I'm timesing everything by 100, but 1 penny is $1. Giving up $1 to get in the trade, giving up $1 to get out of the trade. Maybe you get over on the counterparty and they're the ones giving you the $1, but hey, but you basically no real slippage in trading a product like SPY. Trading something like some of these that we just took a look at, their bid-ask spreads were $1 wide or more, you could be giving up as much as $1 or more to get in to the trade and to get out of the trade. So now, again, options represent 100 shares. When we're talking about you might give up $1, you're giving up $100, right, to get in the trade and giving up $100 to get out of the trade. I'll give you a perfect analogy because I remember this because I think I put this in my book. A situation where one time I got into a trade accidentally. I think it was accidentally. I got in a trade and immediately wanted to get back out. And it happened to be one of these stocks that had just a gigantic bid-ask spread, like $3 or $4 bid-ask spread. You know, huge bid-ask spread. And it cost me like $300 or $400 a round trip within 1 minute to sell the option and then buy it back and get out of it. And that was just slippage. Right? That was just, I got in at a terrible price and I had to get out at a terrible price. But what was my options? My options were, well, if I can't get out at a good price, just sit on it. Well, it was an accidental trade. You know, it was a dumb thing. You know, dumb things happen. But the point is, that was an accident. You should never purposely get yourself into something like that. So when you see really wide bid-ask spreads, avoid the stock. For me, you know, for most stocks, anything more than like a 10-cent wide bid-ask spread, I would wonder about. Now, it'll depend on how the share price of the stock is. Like if it's $1,000 a share stock, you know, a 10-cent wide bid-ask spread is fantastic. Like that's extremely good liquidity. That's usually not the case though with really high price stocks. Usually they're the ones that have like $5 wide bid-ask spreads. So it'll depend on the price of the stock, but most reasonable things say anything from, you know, $50 a share to like $200 a share, which is going to cover most of the things you trade. Yeah, anything that's got like a 10-cent wide or even 15-cent wide bid-ask spread or less, it's pretty tradable, right? You'd like to see a nickel or less. The really liquid stuff. You go look at things like Tesla and Nvidia, you know, really liquid products. You know, you got really tight bid-ask spreads of just a couple of pennies. But once you get, you know, you start seeing bid-ask spreads of like 20 cents, 30 cents, 50 cents or more, you know, on something that's a $50 to $200 share stock, that's a bad sign. Because again, you're giving up money to get in the position, you're giving up money to get out of the position. And what's your edge on these option plays, right? Our edge is small, right? You can't be giving up unnecessarily, you know, large amounts of money due to slippage. And that's why, like, you hear everybody talk about liquidity, right? And with options especially. It's all about trading liquid products. You can't trade illiquid products. I mean, you can, but you're giving up so much money to play those, it's usually not worth it. We talked about having some bad trades, some bad losses, especially holding to expiration. We're actually talking about 0 DTE trades, but this could be for any kind of option cycle. You know, why do we typically not want to hold to expiration? It's typically because the losses, right? It actually becomes a really big loss. Let me give you a perfect example here. We might do a few examples. I'm going to do a standard, my kind of trade. I go out about 60 DTE, typical kind of trade that I put on, go out to 60 DTE, and let's do a put credit spread. We'll do a defined risk trade. In this case, I'm going to get 160 credit versus a 340 loss, standard kind of trade I put on. Well, let's go to the analysis. So let's go to curve and analysis. Let me make this wider. So this is our P&L curve here. The orange line is the T0 line. This is what we'd make on the trade if we get an up move right now. If this happened this second, you know, this is what we'd make on the trade. And this is what we'd lose on the trade this second if Google all of a sudden made this move, right? That's the T0 line. I can't really get to a max loss very easily today because there's so much time left on the trade, right? If Google made a gigantic move, and by a gigantic move, let's say Google went down $20 right now, which would be a monster move, like something crazy happened. Well, it would get to 162.5. So let's imagine that move happened today. It'd be right here. I would be down theoretically $169. $169. Now the max loss on the trade's $340. I'm down, you know, a little more than half of that. It's a pretty big loss, but it's not the max loss, and I still have a whole bunch of time left on the trade. For me to realize a max loss today, Google would have to go out of business, right? I mean, it would have to, they'd basically have to file bankruptcy for me to suffer the max loss on this trade today. But let's go forward in time. Well, let's go to the analysis, and let's go forward. Well, let's go forward just a couple of weeks. Well, actually, we'll go forward a month. About a month. And now let's imagine Google made that same $20 move down to 162.5. Now I'm losing about $200 rather than 169. That's not much of a difference, right? Still nowhere near max loss, right? And that's even, you know, adding going forward a month. And the reason is because I put on the trade at 60 DTE a month. I still got another month of time. But let's go all the way to the last day of the trade, which is 19th. Yeah, actually, let's go the day before. 1 DTE. And now, yeah, I'm at max loss. if we get down below like $15, $16, $17 below where we're trading, just because there's almost no time left on this trade, right? I can't really suffer a max loss if I put this thing on at 60 DTE and get out of it at 21 DTE. It's very, very hard for me to ever suffer the max loss. If you hold it all the way to expiration, you're going to suffer a max loss. If you lose, the only, well, I won't say the only loss you can take, it could finish between the spread and you could suffer a lesser loss. But most of the time, if you lose, it's going to be a max loss. And most of the time, if you win, it's going to be a max win. But that's typically not how you want to play it, right? You want to play it for, I put it on at 65 DTE and then at 21 DTE. Well, let's go to 21 DTE because that's kind of the rules, right? Go forward. At 21 DTE, this is why we exit our positions at 50% max profit or at 21 DTE. I can't get to a max loss at 21 DTE. It would be very hard for me to ever come close to a max loss. It would take a serious down move in Google for this thing to, you know, get to that 340 loss. I would need Google to lose 40% of its, like 35, 40% of its value. And so it's a very tough thing to happen, right? A very unlikely thing to happen. So, but with those 0 DTE trades or those weekly trades sometimes people put on, you don't have as much time on the trade. You can't get out of it as early. But if you do trade those things, those 0 DTE trades, yeah, you still want to manage them early. If you hold the expiration, you're guaranteeing that any loss is going to be the max loss practically. I'll give you a better example of something that could be a gigantic loser, or it could be a non-event depending on how I manage it. It could be a gigantic loser if I hold it to expiration, but I can barely lose on it as long as I get out of it early. And this is not a trade I would ever put on. But let's do a back ratio spread, a 2-to-1 back ratio spread. I'm going to sell essentially the 50 delta call, at the money call, right? And then I'm going to go way out here and buy a couple of calls. This is what the risk profile on a back ratio spread looks like. We get a down move. I win small. Basically, I can't lose to the downside. But the up move is what we're playing for with that extra call, right? You got a long call that theoretically could win forever. But there is this valley of death in the middle, right at the two long strikes, where at expiration, I would lose $1,600 and change. If I held that to expiration and we happened to finish right here in the bottom of that valley, I'd lose more than $1,600. But if Google went up to that area right now today, zoom back out, Google actually went to that strike today, I'd only theoretically be down $386, right? Because there's still so much time left on the trade. If I knew that I wanted to play this for a earnings trade, for example, well, this could be interesting. If you were bullish on an earnings trade and you wanted to play this for a one-day event, you could put on something like this, a 65 or 30-day. You'd probably make it less. Probably do like a 30-day trade because it's the monthly cycle. And yeah, let's do the same back ratio spread. Well, it's because we went forward in time. Let's change that. There we go. So that P&L that I showed you a minute ago was not right because I still had the time out a month. So really, if you get the move up today, you actually don't lose anything. That's what I was kind of concerned there. Yeah. So I don't lose anything in a one-day move. So I could play this for earnings. If I get the big up move, I could profit from the long call. If I get the down move, can't really lose anything. And then the valley of death, I'm not going to lose anything either. Not in one day. If I go forward, though, that valley starts hurting us. And then if you hold all the way to expiration, yeah, you get killed, right? You get murdered on that if you just happen to fall at the bottom of that valley. So it all depends on how long you hold on to these trades. Generally speaking, on pretty much every option strategy, you're not going to suffer a max loss unless you hold to expiration. Well, that's the danger there. Yeah, Don, yeah, best explanation you've heard. Basically, if you're not profitable by 21 DTE, adjust or get out. Yeah, unless, like it's, on some trades, you might get to 21 DTE and you're not at max loss, but you might be, say, 75, 80% of max loss. Sometimes you'll just let those go because you've already lost so much. You may just, hey, I'll let it ride for the next 3 weeks and see what happens. But most of the time, your losses are much smaller. And for those, yeah, close the trade if you are okay just taking the loss. Most of the time, that's the right move. Just take the L. Or if you still like the trade and want to give yourself more time and can roll out without paying a debit. You never want to pay a debit, especially on a spread. If you can roll out for a credit or basically break even, yeah, just do that. And then you give yourself more time, maybe another month of time plus the 21 days that you already had. Get yourself back out to 50 to 60 days. Then just leave the spread on, see what happens. But yeah, it's all about that time, right? That's why I put on those short puts and MES. By far the riskiest trades I put on, as far as, well, I wouldn't say they're by far, but those are pretty risky trades, selling naked puts in MES. So that's the one trade where I don't stick to 60 days. What do I do with those? Put those on at 90 days, right? Why? It's because the more time, the less likely, well, when the big down moves do happen, I don't get hurt as bad. 60 days would hurt a bit more. 30 days would really hurt, right? It's because there's not enough time on those trades for them to come back to you. That's why those unrealized losses, those negative P&Ls, are really bad on shorter dated trades, where if I got a lot of time still left on the trade, I'm not staring at those negative P&Ls, those huge negative P&Ls.